Hi, I'm Garrett Cayet, SFMG's Chief Investment Officer, here to discuss the events of the first quarter of 2025 and some of what's taken place early on in the second quarter. So after two consecutive years of gains exceeding 20%, the S&P 500 declined in the first quarter. And despite reaching new all-time highs in mid-February, markets reversed course amid policy uncertainty from Washington, which resulted in the worst quarterly performance in nearly 3 years. Market leadership also shifted dramatically. Many of the tech giants that drove the gains of 2024 declined significantly in the first quarter and weighed heavily on the S&P 500. Outside of the US, though, international stocks fared much better, posting one of their strongest quarters of outperformance since the year 2000. Much of that strength came out of Europe, where investor sentiment improved following the announced plans of increased government spending. In bond markets, treasury yields declined, meaning bond prices rose following the policy uncertainty and concerns around slowing US economic growth. That provided some diversification benefits, which helped offset some of the stock market volatility. Now, as we get into the second quarter, equity markets have continued to decline. The S&P 500 fell over 10% in just 2 days following President Trump's announcement of reciprocal tariffs on April 2nd. Prices have bounced back slightly since then on the announcement of a 90-day pause on tariffs for non-retaliatory countries while negotiations take place, but concerns around higher prices are continuing to weigh on consumer and business sentiment. U.S. consumers who are likely already experiencing higher levels of inflation may have limited capacity to absorb additional price increases, and that could put pressure on companies who may struggle to pass on those higher costs, which could end up squeezing profit margins. Lastly, investors have been looking to the Federal Reserve for some relief. But the Fed faces the challenge of balancing inflation risk with slowing growth, and so far, Fed Chair Jerome Powell seems reluctant to cut interest rates. Either way, it seems unlikely that rate cuts alone will resolve the current market headwinds. So far, our diversified approach in allocating to non-US stocks and areas of the market with more attractive valuations has provided some protection for portfolios. But we expect volatility to remain high for some time, so we remain focused on managing risk in the event that this develops into a more prolonged bear market, while also trying to identify any market dislocations that may provide some compelling long-term investment opportunities. Thank you for listening, and if you have any questions about your portfolio, please feel free to reach out to your SFMG team. Thank you.